Have you ever seen a company report what looks like good news and then the stock just craters? Well, that's exactly the story we're diving into today with Great Southern Bancorp, ticker GSBC. On paper, their Q3 earnings were a beat, but the stock, it dropped over 10%. So we're going to explain why the market slammed the sell button despite the seemingly good news.
So let's just lay out the contradiction, because it's a big one. On one hand, you have the earnings results. The bank reported $1.56 per share. That's a beat, slightly better than analysts were expecting. Revenue looks solid too. But on the other hand, you have the market's reaction. While the earnings call was literally still happening, the stock was tanking, closing the day down more than 10%. An earnings beat followed by a double-digit drop? That is a major disconnect.
So the big question is, why? What did the pros listening in on that call hear that made them run for the exits, even while the headline numbers looked perfectly fine? That's the mystery we're going to unpack right now.
All right, first things first. Before we get to the drama, we have to look at the quarter itself, because operationally, it was solid. We're going to build the bull case here, because you really need to appreciate the fundamentals to understand why the market's reaction was so severe.
Let's start with what's called the net interest margin, or NIM. Just think of it as a bank's core profitability on its loans. GSBC's NIM came in at a healthy 3.72%. But here's the kicker. It's expanding. It's up from 3.42% a year ago. In this kind of economic environment, folks, that is excellent performance.
Next up, let's talk discipline. Take a look at their non-performing assets. These are basically the bad loans, the ones that are at risk of not getting paid back. They stood at just 0.14% of total assets. I mean, that is an exceptionally tiny number. It tells you their loan book is pristine. They are not taking on foolish risks. So whatever spooked the market, it wasn't bad loans.
And on top of all that, the company was busy returning cash to its shareholders. They bought back about 165,000 shares in the quarter, and just a month before that, they'd announced a dividend hike. These are classic signs of a confident, healthy management team that believes in their business. Everything looks great so far, right?
So we've got a strong margin, pristine credit quality, and cash going back to shareholders. Why on earth did the stock fall off a cliff? Well, here's the turn in our story. We're moving to the other side now, because the market wasn't looking at the last 3 months. It was looking ahead to the next 12.
The entire sell-off really can be traced back to two specific headwinds that cast a huge shadow over the bank's future earnings. Investors on that call looked right past the good Q3 numbers and focused entirely on these two looming problems.
The first worry was a shrinking loan portfolio. You can see here, total loans have actually fallen by about 4.7% since the start of the year. Management explained this was due to a lot of commercial real estate and construction loans getting paid off. For any bank, loan growth is the engine for future income. And when that engine starts to sputter, investors get really nervous.
But this was the knockout blow. For a long time, the bank had an interest rate swap that was basically a money printing machine, adding about $2 million in pure income every single quarter. On the call, management confirmed it. That swap expired on October 6th. That $2 million quarterly tailwind, it's gone, vanished.
And you better believe the analysts on the call zeroed right in on these weak spots. Damon Delonte from KBW immediately went after that growth issue, asking management basically, so where exactly are you going to find new loans to replace the ones being paid off?
Management's answer? Well, it was careful. They said they see opportunities all over the place, from Texas to St. Louis. But they also admitted that these high payoffs are making net growth really difficult to achieve. The market heard that and thought, uh-oh. It was a clear signal that replacing that lost income from the swap was going to be a real uphill battle.
So what do we have? We have a high-quality, well-run bank getting punished for some very real forward-looking problems. The market sold the news hard. But now you have to ask, was it overdone? This whole thing sets up a fascinating dynamic for next quarter, which brings us to a potential trade idea.
Okay, here's the pitch. The market has already priced in all this bad news. Our thesis is that GSBC's management team is disciplined and skilled enough to outperform their peers even while navigating this tough patch. That leads us to a relative outperform rating. So how could you express that view? A pairs trade. You go long GSBC, betting on this specific team's execution, and at the same time, you short the KRE, the main regional banking ETF. This helps hedge out the risks facing the whole sector. This way, you're not just betting on banks to do well. You're making an isolated bet that GSBC will outperform its rivals. It's a classic play on quality during a period of uncertainty.
So there you have it, the bear case, a shrinking loan book, and a vanishing income stream. And the bull case, a best-in-class bank that just went on sale. We'll have to see who's right come next quarter. And, as always, our final reminder, this is not financial advice.